Hey everyone, thanks for joining us again for another week of NAAIM Confidential. Joined today, I'm Branden Ducharme, Ducharme Wealth Management out in Utah, joined by Josh. Help me with the last name.
Kneller, silent K.
Keller, yeah, Silent K. I always trips me up.
That's all right.
Josh, uh, you're out in the Midwest,
Indiana.
Indiana. Yeah, it's the Midwest.
Yeah.
And right before we hit live on this, me and Josh were having somewhat of a spicy debate on the name exposure index, which is our own sentiment indicator of how active investment managers are currently positioned within their equity sleeves, right? So not, how much equity exposure they have relative to bonds or commodities or other asset classes, but within their equity sleeves, how much exposure do you have? Are you half exposed? Are you fully exposed? Are you leveraged? Are you short? What's the net component? And how does that net out to? We're just talking about the way that is reporting, and it's so useful, not because it's a view of, hey, how many people are actually taking up leverage positions or going short or anything like that, but as a general consensus of active managers, how are people really positioned in an aggregate from a sentiment point of view? So this week's number is 92.21, which means it hasn't been a stellar week for active managers per se. For some of them, obviously, the NASDAQ 100 just closed down on the market. It was about 3.5% down this week, I think, from peak to trough. And obviously, across the board, a lot of people were exposed, but not fully. So some people were leveraged, some people might have been short. I don't know, but overall, investment managers are feeling like the market's heading north. One of those classic. Josh, you ever heard of an LLUR chart?
Give me more.
The
Maybe
lower left to the
lower.
upper right.
Okay, got it.
Yeah.
Yeah. Um,
What's
so
your
are you well, hang on, are you asking me about where we are on the sentiment? That's what I'm curious. I didn't know if
No,
that was
no,
a
I'm just
question. Okay.
highlighting what it is, and we're as a total. But I'd love to know. I mean, you're welcome to share. I think people want to know, how are people positioned and what's their view. I mean, are you guys currently in a broad sense, right? You guys at your shop, I happen to know that you run a number of different strategies,
Right.
including long shorts. You guys have precious metals focused strategies. You have classic equity strategies. In fact, you have an award-winning strategy from last year as well. But how are you guys generally positioned? Are your
Yeah.
signals generally saying kind of risk on, risk off,
Yeah.
cautionary?
Blanket statement across the board. We are long. Most of the leverage is turned off. It's not on. If it's available, the majority of the strategies are not utilizing it right now. And I need to, I guess, back up. We run a lot of strategies. We actually have 38 of them. So I get to talk out of both sides of my mouth. Yes, this one looks great. So be careful. But as a blanket statement, when we talk about them, we are equity on right now. We are a believer in what's happening. But understand that we do not forecast, and we're not a fundamentalist at all. We are technical, reactive. Period. Don't ever mistake us for somebody on that other side. There are other great managers who do that.
Well, yeah, I think that's something I always like to talk about on this program, is that active management means a lot of things,
Mhm.
right?
Right.
The way that you actively manage is wildly different than the way that, Stan Druckenmiller manages, right?
Right.
And he's a macro fundamental, macro investor, right? Some guys are completely on, macro data and fundamentals, and some guys are purely technical. Some guys are very tactical and directional in the market. Some guys don't go that way. Different guys touch different asset classes too, and so everyone's worldview is a little bit different.
Yeah,
Um,
and we would be in that category. We touch a lot of different asset classes depending on the strategies.
sure.
That's how we get the diversification. That's how we get non-correlated assets, things of that nature. But not all strategies can go across style boxes at all with us. It depends on the strategy.
Yeah. So speaking of non-correlations, I think one of the big non-correlated asset classes, or historically, non-correlated asset classes, would be gold, right? And
Sure.
precious metals, when you're talking about correlations with equity components. And gold the last several weeks has been on somewhat of a tear, right? It's had a pretty healthy trend. So for the trend followers that caught the trend, it's been good.
Yeah.
You guys have something that's interesting about you is you're using gold in different strategies at different components. Some strategies, you guys, I understand it, use it as a defensive component because of the non-correlation nature, but you have some strategies that are focused on using gold as the offensive position.
Correct.
What's your general consensus of do you have a thought of why gold? Why now? What's it doing in the market? Do you have thoughts about what's driving it? Obviously, not the forecast, but what's causing
Right.
it?
Well, you asked multiple questions there, so let's back up a little bit. You are correct. We do use gold as a defensive investment in a handful of our strategies. That is correct. Right now, if those are equity, they don't own gold. They have zero holding in it. Then again, on a program that uses gold as the active, what I want to own, the equity, as I would say, the alpha. Right now, we are not in gold. We are actually in cash on those positions. So for us over the last few weeks, gold has not been a great play for us, but you have to back up historically. It's funny, if you look at gold standalone, just GLD, the ETF or the precious metals index, you will find on a Callan chart or an Ibbotson chart or a style box chart, the little squares everywhere. If you add gold to that, it's one of the top three performers over the last 20 years. Yet in this industry, we're taught to, gold's kind of a loser investment. Now, having said that, you need to really trade or utilize strengths and weaknesses within that marketplace, and that's what we're attempting to do. Are we spot on, always right? Heck no, just like anybody. But if we can add value, that makes a lot of sense. And if we can bring in a non-correlated asset and cover the weaknesses of the equity strategies, which you can do with that at times, and really protect. And what we found is that, hey, we have the same long-term returns, maybe a little bit better, but nowhere near the downside volatility on the client's portfolio. So I would tell anybody who's thinking about utilizing gold or precious metals, silver, etc., take a look at it, but don't get stuck, buying and holding it for a 5-10 years period of time, because there are 5 or 10 years it just doesn't work. It's a flat line. You have to be somewhat active in it. You have to. I want to say trade it. And trade to me doesn't mean day trade or daily or monthly. You have a set algorithm, a set protocols like what we do, and that's how we manage the gold, the silver, precious metals, different programs that we run, and we have a handful of them.
Yeah. So I would like to get your take on why gold now, though, right? So overall, you run it and look at it as this non-correlation that can
Right.
produce return when the market's flat, but it can be flat while the market's up. And that's the beauty of the non-correlation side of gold. But do you have any thoughts about what, gold made a big move, right? It's trailing 3 months, it's up almost 15%.
Yeah, it's up big.
Is that because I would never expect that somebody in a quantitative model has some component, but like when there's some managers I work with that when, was it like Hezbollah or the whole, conflict in Israel, right? Kicked off and, the market sold off, and I was joking with them, like, why are you guys still exposed? Do you not have the, international terrorism indicator built into your model? It's like,
No.
but so I wouldn't expect you guys have like, the Chinese central banks is buying.
No, and you're spot on. You're spot on. We don't. But let me put it this way. There's a very simple answer.
Okay.
The reason gold prices are going up is because there are more buyers than there are sellers right now. That's very simple. It doesn't matter what the entity is, whether it's gold or silver or an individual stock. I don't care. If it's going up, that means you believe you can buy it now and sell it at a later date, whenever that is, whether it's next week or next month or next year, to somebody else at a higher price. That's why you buy it. That's really what's there. It's got momentum. Now, why do I think it has momentum? I can answer that. But having said that, that doesn't impact how we trade it at all. Zero. And make sure I want
Good
to
clarification.
qualify that. Yeah, I want to make sure you understand that. Some people still believe gold is a flight to safety. And at the end of the day, people still want to own physical gold, or they want to own gold-like investments. I'm not disagreeing. I don't really care what name is on the door of what we own. I want to catch what is performing in today's marketplace. Where's the momentum? Where is the strength, the alpha? Who's the top dog? And the way I explain it, it's kind of like having a ladder. Um, I don't necessarily care who's at the top of the ladder right now. I want to know that's important, and I would like to own that person or that investment. But I also like to see who's moving up the ladder the fastest, and I'd like to own that person too. That makes sense to me. And gold tends to move in cycles. It is very short time periods that you can make a lot of money, and there's a lot of boring times too. It's kind of like fishing. At time, if you know what you're doing, you can go and catch big fish, and it's fun. But a lot of the time, you just don't want to play the game. It's boring. And that's kind of the way the gold is for us. And when you say gold, I actually want to extrapolate it back. We run an alternative program, which to us, alternative means anything that doesn't fit a style box, meaning it's not large cap, small cap, growth, value, etc. It's not OTC or emerging markets. It doesn't hit those little square boxes on everybody's chart. It looks at things like natural resources, precious metals, water, technology, healthcare, all that type of stuff. And that strategy that we run right now, 55% of it is in precious metals and gold. So that would tell you that of all the weird stuff out there, the momentum is exactly what you're saying. It's toward the gold. Now, why? Yeah, I don't know. I don't have a clue. I'll be very blatantly honest. I have no clue as to why. I think I know, but it doesn't matter what I think.
I think one of the cool distinctions that you made that a lot of people might have just overlooked is how pure your idea or concept when you're talking about gold. The only reason you buy it is because you think you can sell for more at a later date. There's nothing else to punch into the model, right?
Correct.
There is no production, right? You buy shares of a blue chip company because you think their sales are going to be good. They're going to tighten their overhead expenses, and it's going to increase profit margins. And you're looking for that production, and it's all pricing, future cash flows priced in, brought back to the present and valued today. And people have different methods of how to come to those valuations. But the point is, it's all based on some kind of production and revenues in the future, right? Even if it's a non-profitable tech company, you're forecasting out
Correct.
how much is this company going to be worth later because of the production. There is none with gold.
It's a
Pretty
pure
pure.
price play. Pure
It's
price play.
pretty pure.
Yeah.
But it also comes with a carry cost because of that, right?
There's no utopia.
Yeah, no utility.
At the end of the day, the way we work within the precious metals markets, whether it's gold or silver, and I should say the alternatives, I should say, momentum is a huge component of what we
Okay.
do. Huge. Is it number one? It's way up there, but that's not the only way we don't trade solely based on momentum. You people do, and other people trade based on the VIX. That's fine. Every strategy works until it doesn't, and that's always been the truth in this industry. There are a lot of right ways to invest. There are a lot of wrong ways. The question is, can you ever own both? Yeah, and people have that. We look at the precious metals from our as a firm and say, okay, is this appropriate for a portion of your money based on what you're trying to do? And if we can add in non-correlated assets and achieve the same end result, but smooth the ride, get rid of the peaks and valleys, that's successful. Adding value is a lot of people think adding value is just based on total return, and that's a very big part of it. But same with a risk adjusted return, same with a downside volatility. To me, the most of all of our strategies that we run, the most important thing to me is drawdown. It always has been, and it probably always will be. I don't see why it couldn't be, because that's what I call the pain. That is where the clients see it. And we all remember, once a client sees a value on a statement, it's theirs. It's always, you lost the money since then. It's not phantom. Once they see it on a statement, it's like a lock. They think it's realized, it's theirs. And so if we can curtail the downside, we can get even a lot quicker when we take stupid pills, and at the end of the day have more money. It's a lot easier to protect and preserve at times than it is to hit home runs. And that's what Atlas as a firm, what we do.
Well, I think, there's an interesting component. I always go back to the Morningstar data, right? When they track the actual, fund flows,
right?
And over the same time period that the S&P 500, I can't remember. I really need to find the white paper on this. It's somewhere. If somebody's listening and they know where this is, send it to me, please. But it talked about how over the same time period, the S&P 500 had a return. It was like 6.5%. But the average investor, the average return out of the same S&P 500 fund was like less than 4%. And it's because when the markets are selling off, people sell out, right? And people tend to buy on the up days, right? Oh, the market's going up, so now I'm going to buy.
What you're describing is the quantitative analysis of investment behavior. I have that. I have that white paper. It's a couple of years dated. They update that every year, and you will find that the average equity investor on their own grossly trails the S&P because they watch something and they say, oh, I like this. This is good. This is a good investment. And they watch it for a period of 6 months, a year, and they say, oh, I think I ought to own this. And they've already missed 80% of the upside of whatever that is. And it's the timing is emotional, not it's predicting. It's I've never seen, and this is this is kind of one of my quotes. I have never in my life seen a newspaper article or headline that says psychic wins lottery. I have never seen it. And if you ever find it, I'd love to see it, because nobody can predict it. Nobody. Anybody who tells you that, oh, we see this, I don't care what you see. I like to look a little bit backwards and a little bit further backwards instead of, it's like, if you drive your car looking in the rear view mirror the whole time, you're going to have a problem ahead of you. But if you never use your rear view mirror, you're going to have a problem as well. That's why they have them. And that's the way we manage the money. But you're exactly right. I've seen that white paper, and they're almost 3% behind on an annual basis. And 3%, if you understand rule of 72, that's 1.5 or 2 more doubles late in the game. It's huge.
Yeah.
So I have that. Just I'll make sure you get a copy of it.
Thank you.
That was not set up, by the way. That was pure coincidental.
No, that's great. I think I think what you're starting to touch on is the behavioral component of active investment management, which gets dogged on pretty hard a lot of times in most recent years, because you've been able to buy and hold and have a nice return, and we haven't had any years of significant drawdown except for 2022. And in 2022, most people, some people did okay weathering it. But what I'd say is the people that it really mattered for didn't. Right. The younger people, the people my age, they just went, oh yeah, hey, we just saw it drop like this in COVID and it just came right back. I'll just buy more. The people that had 60-40 allocations and saw their bond positions that were supposed to be their ballast get completely crushed.
Yeah, and in some cases down more than the equities.
Yeah, and that still hasn't come back. And so that's a lot more painful. And those are the people that have the tendency to make the emotions run a lot higher. Right. And so for me, I've always thought about active management, and I think about drawdown the same way, because it has so much more to do with the longer you can keep somebody in the game, the more chances they have of being successful, right? That's the fundamental principle of investing. So you could tell them, for me, it's like you could tell them, hold on and just ride the roller coaster, or you can try to do some things to manage drawdown in hopes to help them not have to experience the same amount of pain, if you will, right? Like that's the word you use, pain.
I use the word pain. I'm older. I remember 00, 01, 02. I remember 08, and I remember the capitulation of people. The pain was just too great. I can't afford this anymore. I'm willing to capitulate. I'm throwing in the towel. And that's one of the problems as an advisor people run into. What do you do as people's longevity goes 10, 15 years longer than what they were 30 years ago, and they retire at the same time? You have to figure out a way to generate money and generate wealth for that client, but you have to do it managed. I wouldn't take a buy and hold equity portfolio for a retiree. It wouldn't make, that's just not my philosophy. I like to preserve, protect first and say, I'm willing to give up on the upside, whatever the numbers are, because I'm not willing to get buried. And that's really where I look at Atlas and what we do here. Everybody asks us what's some quotes and stuff. All of our strategies are geared to not bury you, not to bury the client, and understand that if the majority of our earnings are made by not losing money, that's the same as making it on the upside. I run into advisors all the time that say to us, and it's real simple. The market goes up 2 out of 3 years, and statistically, they're really close. That's about right over any long time period. But what it doesn't mean is they are making money 2 out of 3 years. It doesn't mean that, because that 1 year where you took the stupid pill, you got to use one of those good years, one of the two, to offset it. So you're really earning back money you lost. And that in the real world, that means you're making new money or advancing 1 out of 3 years. Now, how many people would play the game if they knew that they're only going to make new money 1 out of 3 years? That's not a really good odd. If you're in high school, if that's a 33% on your exams, you're going to be in high school for a long, long time. You're not passing. But if you're playing first base for the Cubs and you're hitting 333, you're in Cooperstown. It's your perspective, your vantage point. And so that's the way, as a firm, we manage money. And what we try to do is get non-correlated, different types of investments. Don't worry about what the names on the door are. Look at the aggregation. And one of my favorite advisors says to me, it's like a pizza. His wife is an ultra health person. He's not. And she says, she makes him close his eyes and try this. And he says, yeah, I love it. And he says, what's in it? And she says, well, it's white chicken, spinach, cranberry. He goes, I don't like that stuff. Yeah, but you already told me you like the pizza. You don't worry about what's in it. Worry about the end result. And that's what we're starting to see. We're starting to see more and more advisors go that way with their clients. I see it.
Yeah, I think the nature of the macro environment is changing the conversation around active management, and I think there's a demand from clients and the public, and they just don't want they don't want, especially the demographic that has a lot of the assets out there, and the most to lose is that baby boomer demographic, right? That people talk about, and they don't feel comfortable with the buy and hold anymore. They know there's too much at stake, and so yeah, you can employ active management and say, we may be giving some up on the upside, just like you're saying.
Yeah,
We're trying to manage
and
risk.
we're cool with that.
Or if they don't find that, what I find they do is they end up, taking their money out of the market completely, right? They don't tend to feel comfortable being in, full on market exposure, buy and hold, ride it through, because they don't know that they have the time to ride it through. And that poses a big problem for them in my experience. And so if you don't help them, someone will, and that someone usually comes with a product that will take some of the risk off the client in exchange for a stream of cash flows. And talk about something that really takes the upside potential off the client, especially when used appropriately. It's really disastrous. So I like active management because you can help somebody maintain liquidity. You can help them try to limit drawdowns. You can combine a more combination of ideas than just style boxes, right? And this is a different experience. It's not for everyone, But I think there's more and more demand from the general public and from high net worth individuals as well, that, they don't want to have the next '08 be experienced in their
Right.
portfolio.
Well, yeah, I 100% agree. Even if you're not right on everything, it's okay. They understand that you are trying to do something. They like to see that activity, and I'm a big believer in it. It's like walking up to the line of scrimmage as a quarterback, and you have a run play called to the right, and there's 11 defenders on the right. Well, that play is not going to work. You probably ought to have an audible. And that's really what active is. Now, we can define active a lot of different ways, and there's a lot of great answers to it. But I like the ability to have the audible to assess what's happening in today's marketplace, but do it objectively without opinion, and do it based on data, and say, based on the data, this is what these are if-then statements. When I pull the trigger on money, it is a black and white decision. A trained monkey could do my job. That is the truth. I mean, as long as you follow the system, you get the same answer. Go do it. No emotion. Okay.
Yeah. Well, I think back to, one of the most quoted people out there for, passive index investing is Warren Buffett.
Sure.
And he says most people should just buy the S&P 500, right? You can't, it's so hard to outperform it. Blah, blah. He doesn't own the S&P. As far as I know, he does not own the S&P 500, a lot of it. What he does own a lot of is Berkshire Hathaway stock.
Right.
And I can't think of a more active investment than the way that he invests Berkshire money. There's nothing, they're not plugging in a quantitative, but, sell at this point, or, on this technical or anything. They have a process, they follow the process, but
Right.
it's active, and we'll call audibles. And part of their process is looking for things like an economic moat, which is it's not a quantifiable, factor in your analysis, right? Like, how wide is their economic moat? It's hard to quantify that, right? It's a qualifier.
Correct.
And he's done quite well.
Right. But hang on.
My point being, this is my point. His approach, though, still as active as it is, and as different as it is from technical analysis, right, or from fundamental macro investing or whatever. His value approach is based upon managing risk through, right, proper valuations.
And it's rules based, the way they look at it. That rules don't mean emotion ever. Rules are rules, regardless of what's happening outside. Mm-hmm. So to me, that's important. And you will see, and we've done it in the past. There are large gaps of time, years, market cycles where Berkshire Hathaway, whether it's Class A or B, underperform the S&P. But that's okay, and that's fine. Managing expectations of a client, and I find, being more of a manager of, where our strategies are available to a lot of different firms to utilize. I find managing the expectation of the end-all advisor is one of the hardest things in the world to do. I mean, because, why didn't you guys catch all this? We didn't. We're never going to. We that type of an attitude. But same with Berkshire Hathaway. There are times where people said, "Oh, he's lost his touch with reality. He doesn't have a clue what he's." Guess what? Put BRK.A up against SPY and put it on a fast track chart as long as you want. You're going to love that whole thing. Now, are there periods where it doesn't perform? Yeah, but that's okay. I mean,
there's always a period where stuff doesn't perform.
Yeah, that's hard. People understand that.
There's one linear chart that I've ever heard of, and it was Bernie Madoff's.
It was straight bottom left to top right, straight line. Is that what it was?
Yeah. Wow. We all know how that ended. So
yeah. Any other question? I don't want to steal your day from you, but what any other specific topic you want to get into?
No, I don't think so. No, it's been a fun conversation. we try to keep these to 30 minutes, so we're right on the head. And hopefully some of the viewers, took away a couple different ideas, right? About how to look at gold and different asset classes, a couple behavioral points on investment management and coaching clients or managing your own personal portfolio if you're, watching this as what we call retail consumer, right? Or kind of the end client. And I think there's been some value in that conversation. I appreciate that you've taken some time out of your day, Josh. I know you're a busy guy, and coming on to share your thoughts. We do appreciate it.
Well, I'm pleased to spend some time with you. I always enjoy the conversation. Look forward to seeing you in person in Dallas. I think it's this year, later in the year. Is that right?
Yep. The NAAIM Outlook Conference will be in Dallas in October, and that is a conference I don't think anyone should miss. That's probably my favorite conference to go to every year. Yeah.
I agree. If there's any questions that you have, or if you want to get deeper into the weeds on something, I'm always available. Understand you might not like my answers, but they are my answers. And if anybody has questions on what we do, we're Atlas Capital Management. You can been a NAIM member since '93. So take a look in the directory, give us a call. If there's something we can assist on. If you think we're crazy, tell us. If you think we're brilliant, please tell us. I mean, that type of an attitude.
Yeah. I think for the record, I think you guys are both.
Yeah, that's fine. I'll take that. That's a compliment in my world. But hey, be safe. Good luck to you and your family, and I'll see you in person here. I don't know, a few months down the road.